Good afternoon. Welcome to Halftime Report. We're in the middle of the earnings season and numbers are flowing in. Karur Vysya Bank's net profit at 83.7 crore is lower than the CNBC TV18 poll of 95 crores. So it has missed our expectations by close to about 12 odd crore. The stock initially had a positive reaction, though as we speak now, it's tempering some of that optimism. It's still up close to about 1%. One number that we have, and that's the bottom line, which looks lower. The net interest income is just about 18 crore lower than our expectation. I guess that wouldn't be too much of a miss. So that's what, 3% lower than the CNBC TV18 poll. That's
so we're looking back. Okay, that's the important number, the gross NPA number on a sequential basis. There is some worsening out there, so that's not a good sign as well. So the few numbers that we have, but the net NPAs, there's a bit of an improvement out there. So the gross NPAs, there is a small worsening, but the net NPAs, that's an important number. That in fact, there is an improvement. It's come down by around 0.1 odd percent, and the provisions, they have come in low on a sequential basis as well as on a year-on-year basis. We're waiting by now for the loan growth number. The street would be looking at a loan growth of around 10% approximately, so we'll wait by for that set of numbers. But as we speak, the few numbers that we have, the net profit is a tad bit lower than what we were working with. The NI is a little bit lower than what we were working with. Asset quality more or less has been maintained, so that's pretty good news. The absolute number has come up for you on the screen. The gross NPAs has seen a bit of a growth. It's up by nearly around 200 crores on a sequential basis. So those are the broad numbers. Now we're waiting by for the loan growth number as well. Provisions lower on a sequential basis as well as on a year-on-year basis. In fact, the net NPA number, that's come in lower by nearly around 35 crores on a sequential basis. So the asset quality on the whole, in fact, it's mildly improved. So that's pretty good news actually, Rima.
Yes, so the net NPA number is improved, but I think the gross NPA number has expanded, at least for the second straight quarter. In the March quarter, the gross NPA was 6.5%. In the June quarter, it went up to 7.44%, and that is further increased to 7.7%. But as Nigel has been pointing out, the net NPA number has been contained when you look at it on a sequential basis. So it's a mixed set of numbers, pretty okay on the NII front. There is a growth that the company has clocked in of close to about 12% thereabout, I think, on the NII. The asset quality has largely been maintained. A bit of a deterioration in the gross NPA level, though at the net NPA level, it has improved. I guess Abhishek Kothari will also be joining in. Okay, we've got the loan growth number, and that looks a bit disappointing. In the prior quarter, the loan growth was 11.2%, and the street was hoping for a loan growth of at least 10%, in this quarter, and that is coming lower at about 7%. So that is a key metric. And that's coming lower. Abhishek is now with us. Abhishek?
The loan growth is a bit disappointing, and even if you see the asset quality movement from what numbers we can see over there, the asset quality has actually inched up. So loan growth has been a pain. It used to grow at 15% plus few quarters back, and for across regional banks, the loan growth has been declining. Whether you check on City Union Bank or others, the loan growth for regional banks are being hard, and it has not come in at greater rate because of competition. The larger banks are eating into the pies, and that is why you are seeing a loan growth pressure for smaller banks. Back to you.
Okay, thank you very much for that. Let's move on then.
Yeah, right. Let's move on then. I think we have the management of Askig Technologies. That's a stock on our radar. After reporting rather weak set of numbers in the second quarter, the EBITDA margins, they have come in at the lowest levels we have seen since the first quarter of FY19, and very high attrition at around 30.7%. That's another worry, as the street has taken it that way. We have with us Mr. Rajiv Moody, the CMD and CEO of the company, who joins us now on the phone line. Hi, Mr. Moody. Thanks so much, sir, for joining in. Explain this to us. 18% drop in revenues on a sequential basis. Why is that? Give us some reasons out there.
Yeah, thank you so much for having us on the call in the studio today. As you mostly know, that we are a company which is known for engaging in delivering complex engineering programs to our customers. We are primarily leaders in that. In some of our programs, we saw impacts come in because of meeting some of the constraints that are required to be met from an end product design and delivery perspective. The good news is that in the quarter, we indeed overcame all the challenges, and we have a very happy, satisfied customer. but in the due process, I think we have expended more efforts, which led to two things. We had costs that were booked in the quarter, and we couldn't invoice the customer because we didn't meet the milestones. So that was an impact that we carried in the quarter. Besides that, we had two other events that kind of impacted the top line growth. One was a delay in the start with two of our engagements, two of our customers, where we had signed up, one in the ruggedized computer space, one in the automotive space. Those programs will start in Q3, so it's not business that has been lost in any manner. So we'll start those programs in Q3 and have an impact in the revenues in Q3 and going forward. And lastly, what happened was also with one of our large customers, there was a maturity of the product itself, which led to delay. Which led to drops in the defects that we fixed in their products. And the new platforms are only starting in Q3, so we had an impact because of that too. Going forward, we see all these three things all behind us and under control. For the first one, where we have expended more effort than what we had originally budgeted, we are going back to our customers. But until it's done, it's not done. So we would not kind of count our chickens before the eggs are hatched, but just to let everybody know that we are in negotiation talks with our customer to see how we can get compensated for the same. Just to reiterate, the customer is happy with the outcome, so there's no impact with regards to any loss, with regards to any customer going away or having even any impacts because of that factor.
Mr. Modi, just for the benefit of our viewers, what will allay concerns is if you can throw some numbers at us. The actual revenue shortfall this quarter is $3.6 million, 16.4 versus $20 million a prior quarter. You highlighted three key reasons: some budget constraints with your top client, a delay in project ramp up, as well as you booked costs which are yet to be recovered from a particular client because you didn't meet milestones. So can you actually tell us the revenue loss attributable to all these three reasons?
I think it would probably be around the same number as the drop in the revenues.
Okay, no, I meant the breakup. How much would be an account of the...
I can't share that because that's confidential. We can't share that information, unfortunately.
All right. Also, if you could tell us, this entire revenue drop of $3.6 million, then you would say is a one-off, and you're confident that you will be able to recover it in Q3?
Let me correct it. Yes, the impact or the situation that we've gone through is one-off. We will not recover the full $3 million because that's a loss. The time loss part of it is impossible to recover. But the effort that we have expended in some of the areas, definitely we are working on recovering it from our customer.
All right, so if you could tell us, you had a guidance earlier of around $250 million in the next couple of years. That's by the calendar year, I think, 2021. You're sticking to that guidance. That would mean a big growth, I think, of around 30.
Yeah, that's an aspirational goal that we have set for ourselves. I'm sure we are all working towards that as we progress our journey towards that. Indeed, today, if you ask me...
Mr. Modi, that would mean, sir, that you would have to do more than a 30% growth on a year-on-year basis. So that would be quite a tall ask, isn't it?
That is definitely an interesting challenge. First, the correction, by the way, it is FY22, not FY21.
Okay.
So we still have... we count in terms of quarters. We have expended 6 quarters. We are in our 7th quarter running out of the 20-quarter match that we are playing. So we are in the 7th quarter running. Absolutely, it's seemingly a tall order from that perspective, but I'm pretty confident we'll find non-linear opportunities as we progress our journey. And if you ask me today, we are absolutely we are on our job to see that how do we achieve that goal, that objective.
We'll find out more about this non-linear opportunity that you see, particularly since you have cash of more than 500 crores. But Mr. Modi, first, if I could just get your attention on the attrition. That's a very, very high number. Your headcount has been declining for the last 4 straight quarters. What steps is the company taking to arrest the attrition? And more importantly, will it have an impact on your margins? Have you also set out an FY22 margin target?
Yeah, so let me answer the question first on attrition. We have been engaged with many of our customers in 3 different types of business models. One is the fixed price programs, outcome-based. Second is what we call as ODC, where we have the teams working from our premises and in a model which is either we build them on a monthly basis or we build them in outcome-based model. And the third model is what we typically call resource augmentation model, where we have our people sprinkled in various programs of our customers in their premises, particularly the GICs in India. Right. We are seeing that our maximum attrition is in the last category, which is the resource augmentation programs. We are not seeing that much of our attrition in either our ODCs or in fixed price programs. So we have systematically decided to taper down that business model because it's not necessarily a win-win for anyone, either the customer, nor us, nor the employee. So we have been disengaging or moving some of the programs back to our premises. And in that transformation, many a times we are losing people, and we are seeing what we can do to address that, to minimize that. Coming to the headcount part that you have asked the question, we are emphasizing on really cranking up our training engine. You probably may be aware that we are in product engineering in the embedded side as well as on the digital side. And the talent required for us is of a typical nature. And we are indeed solved that problem of training internally. We are scaling that engine up. So we should see impacts of the net headcount growth going forward in the overall scheme of things. So I think attrition is a worrying from a numbers perspective, but when I disaggregate that, I'm seeing how we can manage and make sure we don't lose good talent.
And your margin goal, sir, by FY22?
Yes, the goal definitely from an attrition perspective is, see, in an ODC mode, we typically have attrition of maybe 12 to 14%, okay? And we are focusing on how do we drive the attrition towards that goal. On an EBITDA perspective, our margin goal in FY, say, 22 would be somewhere in the range of about 15 to 17%, keeping all the other parameters constant.
All right.
What I mean by that is the exchange rate and everything.
All right, Ms. Modi, a couple of questions. Then you said that, you'll have a good cash in your books. I'm just looking at your stock is down close to around 10% as we speak. Market capitalization of around 1,150. What's the cash in the books? I believe close to around 500 crores is what that is. And also, if you could give us a sense about the deal wins. Is there competitive intensity, beefing about that?
Yeah, so we have, yes, indeed, 506 crores of cash as of 30th September. We have tested that from the investments perspective that we have no exposure in any of the risky part. That's one thing. Second thing, when you're asking me the question on
deal wins,
I missed the
the deal wins, sir. The size of deal wins and his competitive intensity, moving higher out there.
Yeah, deal wins are good, and as a matter of fact, we can proudly, and I'm proud to say that we are exceptionally good at winning deals in the top tier customers, top tier accounts, okay? And these are global big names that one can think of, and we are systematically winning deals over there. In Q2 we have won, in Q3 we are winning. So I see a deal pipeline. What we probably need to worry and focus more is once we have entered those programs, how do we mine those accounts? And that's work in progress,
sure.
And we should see that's a transformation that we are going through.
Okay, Mr. Modi, we've run out of time completely. Thank you very much for joining in. We need to slip into a very short break on that note. We'll come back with more on the market. Stay tuned.
The Nifty has conquered the 10,200 mark yet again. We have some numbers that are coming in there. Gallon dispatch numbers have come in there. The revenues have jumped up quite a bit, up at around 260 crores. That compares with a much lower base. The net profit number as well has come in at around 31 crores. That compares with around 9 crores approximately. Keep an eye out on that one as well. The stock is moving mildly higher, so that stock should be in focus. Maybe in fact we could get a word coming in from the management as well. Moving on though, the Nifty is holding higher, and also another stock, Tata Metallics, is up. We'll try to get in the management, sometime during the show. The numbers look quite good. Tata Metallics is now up close to around 10%. Remember, on a trailing basis, it's trading at around less than 10 times. I think 9.5 times its trailing earnings, and that's why in fact the stock is running away as we speak. We'll try to get in the management later on in the show. But let's move on to our movers and shakers segment then, and let's start off with Bajaj Finance. Now, that stock, in fact, is up close to around 4 to around 5% approximately after reporting a rather good set of quarter numbers. Let's hear out what the management had to say on its earnings con call.
Just in the first 3 weeks of Q3, both the companies put together raised over 5,500 crores in money markets, both between short-term and long-term, and close to 3,000 crores from banks. So we remain reasonably liquid. In my experience, 2013 was much worse. Of course, there is credit separation. Of course, there is marginal increase in spread. But our experience so far is money is available. It is a little tight. There is more caution. But given the event that happened, I would have expected it to be much worse. I think the efforts by the government and RBI have ensured that in general credit separation emerges. Given the granularity of borrowing mix, strong credit performance, I am not. Last time around when we saw liquidity squeeze or freeze, we were at 35,000 crore. 5 years later, we are at 100,000 crore. We will have another squeeze 5 years from now, so that we are all clear. It's part of the financial system. Events differ. Every time squeezes happen. Last time around it was taper tantrum. This time it's about a failure of a non-bank. 5 years from now it will be something else. It will teach us. Good companies will take the message and build strength in build a stronger business model is the way we look at it. The IRLM's exposure of 229.5 crores was sitting as loan against property. It is loan against a commercial real estate, which is a gift city, 2 towers in the gift city. It's 200,000 square feet of that is occupied. Balance 500,000 is it has marquee tenants as software companies. These are functional buildings. The current LTV on the based on the latest sale that happened in August is at 60%, 62%. It's an exclusive charge on the asset, so we see no reason.
Okay, this is the big deal in the consumer space that we were expecting. Zydus Wellness, which is a part of the Zydus Group, has signed a definitive agreement to acquire the subsidiary of Kraft Heinz, that's the India Pvt Limited, along with Cadila Healthcare. This will include brands like, the much-loved children's milk drink, Complan, Glucon D, Nycil, as well as Sampriti Ghee. 2 large manufacturing facilities in Aligarh and Sitarganj. Heinz had a turnover, the India business had a turnover of 1,150 crore and an EBITDA of 225 crore as of June 2018 on an annual basis. With this acquisition, the turnover of Zydus Wellness will be about 1,700 crore rupees, which will make it one of the strongest players in India's fast-growing consumer healthcare market. The transaction is proposed to be financed by a mix of equity and debt. So that is the big announcement. Zydus Wellness stock. Let's get the intraday chart up for you on your screen. That's higher by 3.5% as we speak. And Cadila Healthcare will also be up for you on your screen. We'll get in Priya and Mangalam to discuss the contours, but let's just get in one word from Vishal Gutka of Phillip Capital. Vishal, is this a big win for Zydus Wellness? What would it mean for the stock and the financials?
I officially don't cover the stock, but it seems to be the good deal for the entire sector as a whole, because malted food category, so it has seen a good amount of trouble from GST demon and category slowdown, and there was some amount of competition coming from new players. So with GSA consumer also selling Horlicks and this has already been sold now, Complan. We believe the category is poised for revival in the coming quarters.
Vishal, what would you make of the kind of money that is being paid for this deal? And do you think there is some merit in the sort of money that is being paid for a category which you likely said is slowing down?
So this 4 times, I think this deal has happened at 4 times price to sale. So it has happened at the multiple of... Hello.
Right, yeah, go ahead.
Yeah. So this has happened 4 times price to sales and maybe 20 times EV by beta. We believe it is in line with the other acquisition that will be made in FMCG space as of now.
And what do you think?
So we expect higher valuation for GSK because GSK is a leader in the operating in this category.
Exactly. So what do you think of this space going forward? Because there is that impending sale coming of Horlicks as well. And if this is sold, if Horlicks is sold at a much higher valuation as you are expecting, there would be bigger and more powerful players for Horlicks as well, now that Zydus is out of the way. So that competition, do you think in that light, this is a good acquisition that Zydus Wellness has made?
Yeah, because it seems that the category is poised for revival because everyone is now, we have 2 strong players coming in, Zydus and maybe whoever acquires GSK. So we've seen that the category is poised for revival. In the coming quarters, we expect the category revival. And going forward from here onward, the focus is going to be a nutrition-based product portfolio.
So basis...
where everyone is going to focus on that category.
So basis this, you would suggest GSK Cons is a better bet from here on because of this deal, is what you...
Yeah, it seems to be a better bet because that is a stock we cover, we don't cover Zydus. So that seems to be a better bet as of now. Because given that this deal has already happened at 4x and with an 8% market share, Complan, GSK has a market share of 55% operating in that category.
Okay. Vishal, stay on. Let me get in Priya Sheth. She's been tracking the story very closely. Priya, as of now, we don't have at least the number of how much they're paying on air. Do you have that number?
Well, Rima, the cost of the acquisition is about 4,600 crore rupees, 4,595 crore rupees to be precise. And it's going to be funded through a combination of debt as well as equity. Now, we do understand that they will be bringing a private equity player on board as far as a financial deal, backing of the deal is concerned. But of course, we got to wait and watch, who that name is and what's the kind of share that they will be actually funding the deal with. But, it's also interesting to understand that it's Glucon D, Nycil as well as Sampriti. These are the global rights that they will be acquiring. Also, at this point in time, Coca-Cola as well as several other consortium of private equity investors had bid for, this asset. So clearly, this win comes as a big deal because it will help Zydus Cadila beef up their FMCG portfolio. Do remember that they have a portfolio consisting of products like sugar-free, Ever Youth as well as Active Life. So this is going to help them build synergies around that brand.
Okay, we're getting in some more reactions. Abneesh Roy is also with us. Abneesh, Zydus Wellness, along with the PE player, the consortium will be spending 4,600 crore for Heinz India, which includes, of course, a lot of products like Complan, Glucon D, etc. But the revenues of that are about 1,100 to 1,200 crore rupees and an EBITDA of 225 crore. What have you made of the valuation, and do you look at Zydus Wellness? Does it look more attractive post this acquisition?
So I think valuation-wise, it's a good deal for Zydus. So it works out to around 4 times EV to sales and around EV EBITDA also on the lower side versus the current listed names on the FY18 numbers. So the average multiple for a lot of the names in this FMCG space work out at around 7.9 EV to sales. And EV EBITDA also broadly in the 25 to 35 EV to EBITDA FY18. So it's a good deal for Zydus. It gives a lot of synergy benefit in current categories. So sugar-free, health, and now Complan will also be in the same category. Similarly, Ever Youth in skin, to that extent, talcum powder also, it will be an adjacency. My question is what would happen to some of the brands like Sampriti Ghee, etc. I think those will be pretty small, so doesn't really swing the needle. Now, GSK's Horlicks will find much more focused suitors because now this is off the table. So now I think clearly it will be more focused and maybe more action happening there. This is also a decent margin business. So if you see 225 crore, if that's the EBITDA, it's close to 19%, 20% EBITDA, which is again a good one. So I think, yes, we don't cover Zydus, but I think it will be it's a good deal. It will bring a lot of scale, so the revenue jumps up in a big quantum, and this is a good category. Just because in the same year two top players were on sale doesn't really mean the category has inherent problems. So if you knock off the last 3 years, which had its own issues of demon, GST, etc., this category used to grow close to double-digit volumes for a fairly long time. So I would expect that with new owners for these two brands, I think the growth will come back. What is needed is innovation, LUPs, focus on protein, focus on the innovations which should go up significantly. I think it will come back as a category. So I think good for the company, good for Zydus also.
Avnish, we understand that there is a PE player coming in as well. The deal, you said, yes, it is available at 4 times EV to sales. But once the PE player comes in, do you think there could be a caveat that, the PE player would be given an exit at a higher price? And I'm looking at the last 3 years' growth, like you said, 1256 crores 3 years ago. Now it's 1185 crores. There would be more investments to make in the category. Do you think from a long-term perspective this is positive and the brand Complan can do better going forward?
Yeah, so now we also need to see how competitive intensity shapes up, because if GSK Horlicks also has a new owner, we would need to see who is that owner. If it is, say, Nestle or Unilever or Coke, which have been in the news, then it's, of course, going to be a very aggressive player. So we need to be watchful of that. Coming back to a question on private equity players, so they will look at longer term. They will invest into the company initially because that's what's required. So we have seen, for example, in Crompton Consumer, not exactly in the FMCG space, but in the same consumption, we did see that innovations and in terms of advertising, there was a marked increase when that deal happened, when the PE player came. So I would say that the PE players will look at longer term. They will invest into the business, and it will be, I think, win-win for both Zydus and PE from a medium-longer term perspective.
Prakash Diwan, stay on. Avnish, Prakash Diwan is also here with us. Prakash, Zydus perhaps had an option of buying Complan as well as Horlicks. They've gone with Complan. What have you made of the deal? And is that the better one for Zydus to have bought into, more synergistic benefits?
No, so it makes a lot of sense because Complan is a slightly premium product, more niche, more smaller market share. I guess it'll be in single digits, whereas Horlicks is more staple, more broad-based. And the kind of money they would have to spend on sustaining the growth for Horlicks would be much higher. And remember, this is a very marketing-intensive business. It doesn't grow on its own. It's not something that people are going to come and pick up from the shelf just because it's available. So, given that, it's important for Zydus to bite into something that they can manage to do better with, and from that perspective, Complan made a lot of sense. And you see the names that are doing rounds for Horlicks, they're much bigger, much stronger, with a stronger balance sheet and capabilities to spend. So at least they are out of the way in terms of, competing with the biggies. They've probably chosen a niche which they could expand very quickly. And remember, it's premium. It's much more premium than Horlicks. So what happens is, with their products, which are available already, sugar-free and all those health consciousness-based products, this is going to be a better fit of sorts. It's also not something that they've overly paid for. So my sense is the market's going to like it, and the way they grow it is also going to be much more manageable.
Prakash, from a brand perspective, because you look at brands as well, from Zydus' perspective, you have sugar-free on the one hand and you have Glucon D on the other hand. How do you think synergies will pan out there?
No. So Glucon D is more of an energy kind of a thing, whereas sugar-free is, of course, just a sugar substitute. So
Prakash, we'll just come back to you. For the time being, we need to, hop across. Finance Minister is addressing the press conference, cabinet briefing, I think, so let's go across.
What is going on in the mind of an individual in the CBI? That itself demolishes the integrity of the persons whom they are trying to support. I still believe that every person is entitled to the presumption of innocence. Therefore, we are not going to prejudge as to who is guilty, but we are committed to ensuring that India's investigation process does not become a mockery as some officers who were in charge have attempted to do in the last few days. Therefore, it is important both for the CVC, both for the Government of India and for the whole country that the integrity of India's investigation process is maintained. And to maintain that institutional integrity, the officers under a cloud must stand out for some time, purely as an interim measure. If they are innocent, they will come back. And an independent SIT will investigate as to what is the truth.
I think that is a comprehensive reply, isn't it? Just one second.
Well, these are, I have told you in the past, the questions which used to be asked in the 1970s. The crisis has arisen now, and therefore CBC made a recommendation now. देखिए, मैं कोर्ट की प्रक्रिया पे कोई कमेंट नहीं करूंगा. Well, I will not make any comment, but the CVC's recommendation and the government's action is intended to restore the institutional credibility and integrity of the CBI. And every Indian has an interest in it. Otherwise, if that institutional integrity is destroyed, the worst form of scamsters will stand to gain.
One question here. Yeah, just one second. One second.
When this SIT will be constituted?
I think a remark of this quality doesn't even deserve a reply.
Sir, when this SIT will be constituted and who will head this, sir?
Well, the CBI will, it's now for the CBI to do it. The Government of India has nothing to do with it.
CVC or CVC, sir? No?
Well, CVC is the superintendent's authority. They will do it. I don't want to answer any questions. Let us see, it's for them. Why should government enter? That means I am making the same mistake which the three opposition parties have done, that I know what is the SIT and so on. I don't know. जो उनकी फंक्शनिंग है, यहाँ वो कोई इंडिपेंडेंट इन्वेस्टिगेशन SIT करते हैं या इंडिपेंडेंट टीम बनाते हैं. It could be an independent team also, and therefore that is the authority of the CBI and whatever the CBC has recommended to them.
That what is the urgency that you had to wake up the DOPT secretary and have this order passed at 2 o'clock in the morning?
Well, I think your question runs contrary to the first question. Some friends have said that it was already too late. The answer is very obvious. The CVC met yesterday. They made a recommendation in the evening yesterday. So if the government is a fast-acting government, we call it why the hurry, and if it's a slow-acting government, we say policy paralysis.
One last question on the subject, yes. The lady there.
Sir, just repeat, you haven't answered. Sir, there are allegations that Rakesh Asthana is actually the blue-eyed boy of the Prime Minister's office, and that's one reason that the government really dragged its feet on it. And that direct allegations that he was...
I think these make juicy stories for electronic media, but...
Okay, that is the finance minister talking about the infighting which is taking place at CBI number 1, number 2. We'll get back to that. In the meanwhile, let's focus on the big deal that's been announced in the consumer space. Zydus Wellness will be acquiring Kraft Heinz India business, which includes big brands like Glucon D as well as Complan, amongst others. Sharvil Patel, the MD of Cadila Healthcare, joins us now. Sharvil, first, if you could just throw some numbers, can you confirm how much you have paid for this particular acquisition? You're talking about it, this being EPS accretive, but what will the margins of the combined entity look like, and what is the growth that you're expecting from the Complan business, considering that, you know, growth for the entire segment has been quite flat for the last 3 years?
So we have acquired 100% business of Heinz India Pvt Limited, which carries 4 brands, Glucon D, Complan, Nycil and Sampriti. The combined value that we have paid for this transaction is 4,595 crores. and it is both the combined entity with Zydus Wellness will have margins of 350 crore EBITDA and a total turnover of about 1700 crores, and will put us at a 20% plus net margin.
Well, Mr. Patel, I just wanted you to run us through the exact structuring of the deal. We do understand that there are several private equity players who will be helping you back this deal. Can you give us the details, please?
So currently it's in the early stages. This transaction will be a mix of debt and equity. The finer details of it still needs to be planned out, but we have keen interest from a couple of PE players whom we are in advanced discussions with. So it will be a mix of equity and debt which will be used for the transaction. Regarding the earlier question in terms of the growth for the products that we acquired, I think there is significant under-penetration for many of these brands that we have been able to acquire. Also, these are leading brands in their respective categories, and with a very high recall, closer to 98% recall for all of the brands, we can see tremendous opportunity to scale this business up, leveraging the backbone of our pharma legacy as well.
Okay. Mr. Patel, hi, this is Ekta. I just wanted to dwell a little bit in terms of how exactly Cadila Health would be involved in the structure of the deal. Currently, what would be the debt that you all have on your books, and how much would you probably incrementally need to take in order to finance this particular deal?
So this currently the way we are going forward with this is going to be 100% acquired by Zydus Wellness through a mix of debt and equity. The Cadila Healthcare, being the large shareholder of Zydus Wellness, will also look at ingesting some equity subject to approval of board and other matters. But largely the transaction will be funded through debt and equity, and with the PE involved as well. Okay. And the current, on Cadila Healthcare point of view, we have comfortable cash flow positions. We have enough leverage still left. We are at only 1.3 times net debt to EBITDA, so we have still further room to expand, but the large part of the transaction is going to be consummated through Zydus Wellness.
Okay, that point is taken, but there are two primary concerns with regards to Cadila Health right now, Mr. Patel, is that, Cadila Health's balance sheet should not be leveraged for an acquisition incremental in the FMCG space. So currently your debt stands at around 5,165 odd crores gross debt, and correct me if I'm wrong, but what would be the incremental debt in case of whatever the structure might be for Cadila Health, which you'd probably have to undertake? That's the key concern that the street has right now.
So it will not be significant, and the details of the structure will still need to be worked out and subject to the approval of the board of Zydus Wellness and Cadila Healthcare. But as I said, the most of the transaction will be funded through Zydus Wellness.
Okay. And would you eventually in some form or manner dilute your stake in Zydus Wellness beyond the 72% that Cadila holds?
It's too early to talk about that right now.
Okay. Well, Mr. Patel, I just wanted to understand, going back to the private equity players that will be investing along with you in terms of financial backing, when will this transaction be closed? Because, early 2019 is when you've mentioned that the deal will finally be closed. So will the funds flow in before that, and what kind of role will the private equity player have as far as this entity is concerned?
So the deal, we are hoping the deal will close in the Q4 of FY19, subject to the regulatory approvals that are required, and the funds will be required at that point in time and not before.
Mr. Patel, one question as far as your overall portfolio is concerned. You have brands like Sugar Free, Nutrilite, Actilife, and many more brands. Now, with this Kraft Heinz portfolio, how will it build synergies with your existing portfolio, and what kind of strategy do you have for these brands going forward?
So I think with the acquisition of Heinz India, I think it's been very good, because to acquire scale large brands is very difficult in the current consumer space at the right valuation. So With the acquisition, the combined entity will have 5 of the 7 brands, which will be #1 ranked brands in the country. The combined distribution will, both having 2.5 lakhs of direct coverage, the combined distribution would go up to 4.5 lakh. And there is significant coverage in Heinz when it comes to grocers versus when it comes to wellness, the chemist and the cosmetic channel. So there is a great synergy on the distribution side where we'll be able to leverage the capabilities to expand Zydus Wellness brands into the grocers channel, whereas the other brands into the chemist and the consumer side of the channel, so cosmetic channel. So both of those have tremendous opportunities. Again, on the distribution side, we have common distribution centers where there can be good synergies that can be created by merging some of these distribution centers as well. And most importantly, I think the way we have envisaged this is both businesses are going to be the growth drivers for the organization. So we will, with the help of the teams both in Zydus Wellness and Heinz India, we will run these businesses independently in the beginning to make sure that we are able to extract growth for both the businesses through the respective field forces.
Any corporate guarantees that Cadila Health will be extending?
The normal guarantees, the normal Cadila Healthcare is also signatory to the overall deal. So they are also part of the SPA.
All right. Thanks so much, Mr. Patel, for joining in and, in fact, giving us all those details. All the best going ahead as well. So that's a big deal that was long anticipated. In fact, it's finally been announced. But let's get back to our own markets. The Nifty is now below the 10,200 mark. So let's pull up the intraday chart. You'll see that the Nifty is hovering around the 10,190. How do you trade the Nifty from here? At one point of time, we were holding with a gain of around 120 points. We scaled down to hold with a gain of only around 20 points. And now some stability at around that 10,180 to around 10,210 odd mark. Ashwini Gujral and Sandeep Wagle, they join us now to give us their trading strategies. Good day, gentlemen. Ashwini, coming across to you first. Trade on the Nifty. What's it from here? And also, what are your picks?
Basically, it's a slow rally. That point is clear. But it appears that the market is trying to form some sort of a base from which, an extended rally can happen. So as long as, 10,150 thereabout holds on, also maybe like 25,050 on the Bank Nifty, you should continue to remain long. One good thing is that IT is beginning to now make a comeback. So that way it may be easier to hold on to support levels. Overall, you should play for a bounce back, and it'll be a difficult rally to trade because you'll get big upswings and downswings, and every 2 hours it'll look like the market is collapsing again. So that way, RBL Bank is a buy with a stop of 478, target of 500. NBFCs are picking up as we go towards the close. So MM Financial is a buy with a stop of 392, target of 410. And Canfin Home is a buy with a stop of 234, target of 250.
Okay. Sandeep Wagle is also with us. Sandeep, how are you trading the stocks now? Your picks?
Afternoon, Rima. I would go with a buy in M&M Finance, stop loss of 385, target 425, and a sell in a Sun Pharma, stop loss 576, target 558.
Okay, all right. Thanks so much, gentlemen, for joining in and giving us your take on the Nifty as well as the trading picks. But there's one stock that's up and about, that's Tata Metallics. Reported a strong set of numbers. The stock's virtually at the high point of the day. So let's slip into a short break. You come back, we'll get chatting with management. Stay with us.
Welcome back. Kotak Mahindra Bank's numbers have hit the exchanges, so we'll just wait by for them to get flashed on your screen. We were watching for the net interest margins to be above 4.2. 1146 is 1,141 is the profit, so that's largely in line with expectations. So Kotak Mahindra Bank's standalone net profit at least has come bang in line with street expectations. Awaiting more details, Abhishek is also going to be joining in to throw some more color. Abhishek, you want to run us through the quick expectations?
Well, Abhishek, just looking at those numbers, the gross NPAs, that's coming standalone. Gross NPAs has come in at around 2.15 percent approximately. So a gross NPA below 2.2% should go down as a bit of a positive. So let's get that number as well up for you on the screen. And the standalone net profit, that's a small, more or less in line. The net NPAs as well, a marginal improvement on a sequential basis. So there is some improvement in terms of asset quality by just going by that number. So the numbers that we have so far, net profit more or less in line, very, very small miss, 20 crores miss. That's very, very small. And in fact, the other numbers that we've got, there's a mild improvement in terms of gross NPAs as well as in terms of the net NPA. So
the NII has grown it at 16.3%. So the NII is a bit of miss, not much, but just 8 crores. We were working with a number of 2698 crores. It has come in at 2689 crores. So just 9 crore miss on the NII. It has grown at 16.3% on a YOY basis and about 4% on a sequential basis. But as Nigel, you mentioned, this is the 6th consecutive quarter that the gross NPA has been on an improving trend in terms of the percentage wise, right from 2.58 in Q1 FY18 to now about 2.15 in Q2 FY19. The gross NPA has been on an improving trend. Back to
some more details. The standalone net interest margin has come in at 4.2%, while the advances has seen an increase of 21% on a year-on-year basis. The CASA stands at 50.2%, which compares with 47.8% that it had a year ago. And the capital adequacy is quite intact at close to about 18%. We already highlighted what the gross NPAs and the net NPAs were. So some more color. So it looks like a pretty decent set of numbers so far. Prakash Diwan is also with us. Prakash, your thoughts on the numbers?
I think everything seems to be absolutely in place. Given the kind of turbulence that the last quarters had, for particularly the growth side, I don't think Kotak has had any issues with that as well. And remember, this is one balance sheet that's extremely, extremely comfortable, given the fact that they've already provided for a lot of the loans that could be questionable, particularly in the SME side. So gross NPA is coming down, net NPA is coming down, your CASA remaining so healthy, so access to low-cost deposits remains intact. Everything seems to be well poised. I think the stock, the only thing you need to realize is the stock's done well from that 1,000 plus mark. It's done about 17-18% higher in the last month or so. So that's something which probably people are kind of factoring in the sense that even with good numbers, the stock might not immediately see an upside, but the re-rating would follow later.
Okay, all right. So those are the broad details that we have. The loan growth as well as coming at around 20.1% approximately. Anything over 20%, should get a green tick. So most of these parameters really are fitting into place. Abhishek, you want to have a word on this? The asset quality, there's been a bit of an improvement, as you said, from around 2.4% to around 2.15%. The loan growth appears a tad bit better out there. And otherwise, net profit as well as NII, small miss out there.
Even the loan growth has actually come down. Last quarter it was at 24%. Okay. So this quarter it is at about 20% plus. That's a bit of a a downtake. However, if you look at the net interest margin at 4.2% is the lowest in last 13 quarters. So if you look at that number is not too good, despite the fact that loan growth has been strong. The low cost deposit share is at 45-50% levels. Despite that, you are seeing a falling net interest margin. So 4.2%, the net interest margin is on the lower side in last 13 quarters, or let's say about more than 3 years. Back to you.
Okay, the company is also given some more color. Their SMA2 outstanding is at 165 crore. They've also given their outstanding loans to the NBFC sector, which is at 13,000 crore rupees. That would compare with about 12,130 crore that it had in the prior year. So the year-on-year growth would be about 7.3%. So that is the exposure to the NBFC segment. To the home loans and LAP, that's close to about 20% of the total advances. So the company is also given some more color on the on the advances and the kind of numbers it's seen. Ashutosh Mishra of Reliance Securities is also with us. Ashutosh, what have you made of the numbers? Loan growth has come down when you compare it to the prior quarter, 21% versus 24%. The net interest margins too, at 4.2%, it's not a bad number. But as our colleague Abhishek was telling us, it's the lowest that we've seen in the last 13 quarters. Should we really be quibbling about these numbers? And any thoughts on the asset quality and the details that they've given on their exposures?
So if you look at net interest margin, they have clearly indicated from the last 2 quarters that maximum of their loan funding to the 6-month MCLR. So the transmission will and the major part of the increase has started from the latter part of the first quarter. So what you will find that the transmissions will be more, the interest rate transmission will be much more evident in the second half of the year. So what we also expect that most probably NIMs will improve in the second half of the current fiscal, and that's what management has also indicated in the last quarter. And loan growth of 21% is also reasonably well. They have already indicated that there is some stress they are seeing in the SME segment, and there the bank is relatively having a quite large portfolio. So probably they may have slowed down in that segment.
Okay. Ashutosh, actually the stock has come off from post the numbers. It's actually now in the red. It's down close to about 0.5%, which means post numbers, the stock has taken a knock of close to about 1%. What would you attribute it to? What would be the misses in the quarter and the hits for you, according for Kotak Mahindra Bank?
See, stock performance of the Kotak will be mainly now highly linked to the way Mr. Kotak's stake from 30% to 20%, how is really going to bring it down, because time period has now become very small on that front. So basically, what is the strategy of Mr. Kotak, how he really want to address that issue is the key things from the performance of the bank on a price basis for the next, at least for 2-3 months period.
Okay, and what would your own target be on Kotak Mahindra Bank, and any reason to change your estimates or the kind of valuation that you ascribe to Kotak Mahindra Bank?
So we have currently target price of 1497 with a buy rating. So most probably we will continue to maintain this. We'll see whether there is any requirement of change post the conference call today.
Okay, thank you Ashutosh for joining in. Saurabh Rathi is also with us from IIFL Securities. Abhishek, you want to ask him a question?
I'll just highlight one point. In last 5 to 6 quarters, the corporate loan growth was higher than the overall loan growth. Now, the overall loan growth has come in at 21% plus, but the corporate portfolio has grown at just 18.5% on a YOY basis. So, the loan growth has been majorly from commercial vehicle, small business personal loan, that is the unsecured portfolio. Mainly, those have driven the loan growth. Now, you look at the P&L and the balance sheet. If you look at the loan growth, 21.2%, the interest income, 22%. So, the yield remain intact. However, it's a cost of funds that is hurting the margins. The 24% growth in deposit, but that compares to about 27% growth in interest expenses. So it is being seen that the cost of funds for the bank is rising. 4.2 is not a small number by any means, but it is on the lower side in last 13 quarters. Back to you.
Saurabh Rathi of IIFL Securities is also with us. Saurabh, your thoughts on the numbers?
Yeah, essentially the numbers are in line with our estimates. Now, NIMs are slightly lower than our estimates, mainly because I think wholesale funding would have gone up. The reliance on wholesale funding is higher, and also if you'll see, there could be faster growth in the term deposits, which have led to a little bit of lower margins. Also, if you'll see last quarter, if you remember the NCLT, the bank had taken one NCLT case, which also done some refinancing activities, which had led to their higher growth in their corporate loan book. So this quarter we need to see whether how much refinancing activities the bank had done, and for that we need to talk to management with regard to that.
Okay, run out of time, Saurabh. Thanks so much for joining in. So Kotak Mahindra Bank is very largely in line with expectation. We'll also want to hear more from Uday Kotak on his outlook on the SME exposure, because that was a risk he had highlighted and flagged off in the prior quarter. With that, it's a wrap on Halftime Report. Stay tuned. Business Lunch is up next.